around 10 or 11 o'clock this morning, and this is on Tuesday, March 4th, it was getting a little dicey in the markets. Stocks felt a little flashy, crashy, 2-year notes were ripping. Commodities, as a result of the tariffs, are crashing, particularly in agriculture. It's just a disaster.
We all know that tariffs increase costs, but does that mean they cause inflation? What if tariffs are actually deflationary? What if they make prices go up, and because of that, demand drops so much that we have a recession, the first recession in 16 years? Well, that's what Wall Street trading veteran Jared Dillian and I discussed today, along with how to trade a recession and how to protect your portfolio. I'm Ed D'Agostino, and this is Global Macro Update. Jared, let's talk about what's going on in the economy. I want to get into your thoughts on if a recession is more imminent. I personally think it is, and I have not been in the recession camp for the last, ever since COVID, but I'm getting nervous. What do you think?
I'm not getting nervous because I like recessions. Recessions, number one, are fun to trade. My newsletter business goes up in a recession, believe it or not. Plus, we've really had 16 years without a recession, so there's a lot of malinvestment and overinvestment that happens. Got to clean all that out. So I'm ready for a recession. I am ready. And also from a political standpoint, if Trump is going to cause a recession, better to do it in the first half of his term. Front load the pain and then come out of it in the second half. You know what I mean?
I could not agree more. Now is the time to give everybody the medicine, right? I mean, he's a one-term president right off the bat, so he's not worried about getting reelected. But there's still the midterms. You got to do it now.
You probably saw that the Atlanta Fed GDP now estimate went negative. It was at 3%, now it's negative. In a month, it went negative.
Yeah, negative 2.8.
It's 100% politically motivated, for sure. Having said that, it's probably true. It's also probably true. We started this, you said, what do you think my odds are? We're going into a recession. I think the odds are higher. Mohamed El-Erian just said that on Twitter. He is the master of the obvious. He's made a career out of just saying the most obvious things. And he's like, oh, I think the odds of a recession are going up. I'm like, no shit. Stocks are crashing. Bond yields are, it's funny. Around 10 or 11 o'clock this morning, and this is on Tuesday, March 4th, it was getting a little dicey in the markets.
Yeah.
Stocks felt a little flashy, crashy. 2-year notes were there was no offer. They were ripping. Commodities, as a result of the tariffs, are crashing, particularly in agriculture. It's just a disaster. So, and the dollar is just getting destroyed, And it really felt around 10 or 11 this morning that there was real stress in the markets for the first time since August, if you remember what happened. And plus the yen is ripping too, the yen is ripping. So we do have real stress in the markets now.
Let's first talk about let's break down all the things that might be indicating that there's a recession coming, potentially, or at least that the odds have gone up. And then let's talk about how to trade it, how you would play it as a Wall Street trader. Let's start with interest rates. What are they saying? Are rates going down because there's a flight to safety, or are they pricing in the success of government cuts?
I would say last week or the week before, they were pricing in Doge. But now it's become more about the economic outlook, I think. 2-year notes are still above 4%. I think they're 4.1 or something like that. And if we have just say 6 rate cuts this year, that you're looking at a 2-year note in the low 3s, So even as much as twos have moved here, I think I still think the bond market is a buy. even at these levels.
What about the 10-year bond, right? Because that is the bond that mortgages, the mortgage rate is set off of the 10-year. Scott Bessent, Secretary of Treasury, and President Trump have both said repeatedly that they want the 10-year interest rate to come down.
Yeah, it's funny because, Trump in his first term was targeting the stock market, and this time around he's targeting the bond market. And if that's, Bessent, I think, knows what he's doing. I would not be surprised to see 3.5 on 10s in even a month or two. Like it could get there fast, which would be good or bad for the housing market, depending on your point of view, right? Because you've had all these people that are trapped in these low interest rate mortgages. You get mortgage rates down to 6% or below, and people say, okay, I can move now, and they list their homes, and you have all the supply on the market. And so prices come down. I think that's possible. I've seen some charts recently about home builder profit margins, which are the highest basically in history. And, here in Myrtle Beach, D.R. Horton, Lennar, we used to call him Dr. Horton. So Dr. Horton and Lennar, they're cutting prices on new homes by a lot, by like $60,000. The inventory of single family homes is the highest it's been since before the financial crisis. So housing market is looking, and I've been a housing bull, but the housing market is looking a little weak here.
That's kind of what I wanted to key in on, is a lot of people who I think got the last couple of years right are starting to shift their thinking, which really has my attention. Like guys like Neil Dutta from Renaissance Macro. I was listening to him on with Tom Keene last week on Bloomberg Radio, and he's been fairly consistently bullish. And last week said, look, I'm getting concerned.
I've been concerned for a while. I started getting bearish in July. And then we had that puke, the end carry trade blow up, or whatever you want to call it. And which I thought would turn into something bigger. And literally like that crisis lasted a day, and then we made new highs. But I've been pretty bearish on and off since July. And I think this might be it. In terms of, you talked about trading it. So the S&P 500 got down to the 200 day today, and it bounced. So probably going to bounce around here. We had payrolls on Friday. If we have a weak payrolls number on Friday, then probably through the 200 day. And there's really no support below that at all.
You mentioned payrolls. Let's talk about unemployment. Right now it's at 4%, kind of the Goldilocks level, right? Like it's sort of perfect for the economy. But we're hearing about all these layoffs now. We're hearing it's not showing up overtly in the data yet, but the anecdotes are really starting to crank up. Lots of companies started in tech. Now it's sort of spreading out. There's a question as to whether it's due to the economy or whether it's due to AI and automation just putting efficiency on the table for these companies. And so they're saying, well, why wouldn't we become more efficient? Where do you think's happening in the labor market directionally?
With respect to the labor market, the first thing I want to talk about is the government. Because the government was the biggest contributor to jobs added over the last couple of years. Most of the new jobs are going to the government, and now we have Doge laying people off. So I heard somebody emailed me, and the guy was being kind of a jackass, and he's like, dude, what would happen if unemployment went to 9% because of Doge? So I'm like, all right. So I went to Perplexity, and I asked, how many federal workers are there, ex-military, ex-post office? And it said 2.4 million. And I said, okay, what would happen to the unemployment rate if 2.4 million people got laid off, like all government workers? And the unemployment rate would go up 2 points. So it'd go from 4.1 to 6.1. So if we laid off every single government worker, the unemployment rate would go up 2 points, which is not a lot. And we're not going to lay off every single government worker. So But really, I think where there's network effect isn't the word I'm looking for, but correlations or whatever. Like you start laying off a third of government workers, now you're putting contractors and beltway bandits out of business and people downstream from that. So there's kind of a multiplier effect. So even from Doge, I think you could get the unemployment rate up to 6 or 6.5, just from government layoffs. And now all the things you mentioned with the private sector and AI and stuff like that, look like, I got to throw private equity into the conversation. If private equity croaks, private equity owns, I don't know how many trillions of private businesses. They are going to remorselessly lay people off in a downturn, right? They are not going to hang on to workers. So a lot of these layoffs, I mean, and this is all kind of doomsday talk and stuff like that. Like this is like worst case scenario. But the layoffs could happen fast, right? So I think in a worst case scenario, we could end up with unemployment at 7.5%, 8%. That's like the worst case scenario. I think base case is probably 6.5.
So if you think about that, the other sort of thing that people have been worrying about in the markets over the past few months and well beyond has been inflation, right? But if we have an unemployment rate of 6 or higher, interest rates are going to come down. There's not going to be inflation, even with tariffs would be the argument. So let's unpack all that.
I think that tariffs are actually deflationary.
Yeah, I do too.
I think it's the opposite of conventional wisdom. The conventional wisdom is that tariffs are super inflationary. We're going to be paying 25% more for all these goods. It causes inflation. Actually, what tariffs do is they slow down the economy, and it's a deflationary force. So just in the last couple of weeks, you've seen the Truflation data drop to 1.3%. So, I mean, it just gap lower. So Truflation is at 1.3%. This is like we are experiencing deflationary forces right now. Inflation is not going to be a problem. I don't remember which Fed official, I mean, they all say the same thing, but some Fed official was saying we have to be vigilant about inflation and all this stuff. They are not getting the joke. Inflation is not going to be a problem, right? So, and they'll figure it out eventually, but the rate cuts will come too late, is my guess.
You really think we'd see 6 rate cuts this year?
Yeah, I mean, we're pricing in 3, so that isn't that much of a stretch. We're currently pricing in 3. So I think, 6 25 basis point rate cuts that takes you down to 3%. I think it's possible we get more, but I would say that's kind of base case.
So I have no way to verify this, but several news outlets reported, and whether you trust them or not is another story, but let's just assume that they did some due diligence. Several news outlets reported that your average car price is going to go up by $12,000 if the tariffs that are currently being put forth on Canada and Mexico stick. I can't imagine the car industry not getting anything but decimated if the average car price goes from roughly $50,000 now up to over 60. That sure seems like a break on the economy.
I hate doing this, but this is kind of stuff I was writing about months ago with the tariffs when Trump was first talking about this stuff, when he said tariffs was his favorite word. Like, I actually used that example in my newsletter. I was like, look, a $50,000 car is now going to cost $60,000 and people are going to squeal. Like, I think everybody was in love with the idea of tariffs in principle, but I think in practice, it's going to be very ugly and people are going to be upset very fast. So yeah, I mean, I'm sort of in the market for a new car, too late. Like I can't do it now.
Yeah. My whole cabinet is filled with tequila and avocados. So I'm all set there. There's supposed to be an offset to these tariffs, right? But the interesting thing is I haven't heard a lot of talk about the potential offsets, right? And you wrote about it. You write for Reason Magazine. You wrote about potentially flattening the tax code, make it a flatter tax. Where is the offset to tariffs? So if tariffs are supposed to contribute revenue to the government, in theory, there would be an offset in our taxes.
The offset is the dollar, is getting the dollar down. That's the offset. So if you depreciate the dollar by 10 or 12 or 15%, then really the impact of the tariffs is negligible, at least from an exporting standpoint, you know. So that's kind of the release valve.
Before we go any further, let me just ask that you subscribe to the channel and leave us a comment or a question. I really appreciate your help and your support of this channel. If you want to know when we post new videos, sign up for our weekly email notification. There's a link in the description below. Now back to our discussion with Jared.
I was actually looking up about the Plaza Accord in 1985. I don't know what you know about the Plaza Accord. I didn't know much. Actually, it was kind of before my time. I had to look it up. But in the early 80s, the dollar got very strong. So there was a bunch of G10 countries that got together to exert some influence on the dollar and try to get it lower. And boy, did it ever get the dollar lower. Like, you can look at a chart of the DXY going back to the 80s, and there was a peak, and then the dollar sold off like 35%. So, I was at a conference last week in Kansas. I put up a bunch of charts about the dollar. The dollar is following the exact same pattern from 2017 in Trump's first term. Dollar rallied a couple of percent in 2017, and then it sold off like 12% for the rest of the year. Same thing's going to happen.
What do you think the impact is going to be on U.S. exports? And one of the things that I want to think about with you is some of our trading partners are really pissed off at us, namely Canada, like really, really mad, and are going out of their way, at least at the retail level, the consumer level, going out of their way to not buy U.S. products. Will that happen at the factory, industrial level? I don't know, but this is an interesting little wrinkle.
Yeah, I actually have a Canadian Facebook friend, and she's posting all this stuff about boycotting U.S. products. And I'm like, those types of things don't work, and they're stupid, but people are upset.
Very upset.
Yeah.
Yeah, we have a lot of Canadian viewers, and they weighed in pretty heavily over the last month. I'm not too pleased. Like, I didn't do it. So do you think that overall U.S. exports, ag, let's take ag, it's getting crushed this week?
I think that on balance, the trade deficit will go down. That's what happened in 1985. We were running record trade deficits, and the Plaza Accord worked, the dollar came down, and the trade deficit got smaller. So I do think that's going to happen.
Trueflation down to 1.3%, you said?
Yeah.
What a change.
I'm super bullish on bonds. Yeah, I mean, getting back to the earlier point, we're going to, the front end of the yield curve is going to be pricing in rate cuts pretty soon. And I think I misspoke earlier. I think I said that 2-year yields were at 4.1. That's actually where 10-year yields are. I think 2s are like 3.8, 3.85, 3.9, something like that. But still, like, if we're going to get 6 rate cuts this year, which I think is going to happen, the bond market has a long way to go, which from an asset allocation standpoint, I talk about the awesome portfolio and how everybody should own 20% in bonds. And even people who hypothetically are doing a 60-40, like, you have to make sure you have the 40% in bonds.
It might be time for me to finally, Jason Brady was lecturing me 2 years ago to get out of the 3-month T-bills and move out farther on the curve. And I didn't. I've just been hanging out in the front end, and it's been great, but I guess it might be time to move. One other thing that factors into potential deflation, energy prices. I mean, oil is getting crushed. which bums me out, being long oil producers. OPEC Plus announced that they are going to increase their output in April.
I saw that. Yeah.
So energy costs are going to keep going down.
I'm sort of conflicted on that. From a technical standpoint, the charts are telling me that that oil is bottoming here, right? I think from a technical standpoint, we have more or less formed a base in oil. And I don't think there's much downside. However, from a macro standpoint, if you believe we are really going into a semi-severe recession, there could be a lot of downside in oil prices. You know what I mean? I mean, just using 2008 as an example, like oil went from 140 to 30 in a couple of months, So, like I said, I'm a little bit conflicted. Sometimes I put a little too much faith in my chart reading abilities, so I'm kind of a nervous long in oil.
All right, well, let's talk about how to trade this. So let me give you the poster child that I want to think about here. You're 45 years old. You've been long the market, just the market, right? The S&P 500. You've made a killing over these last several years. Up over 20%, 2 years in a row. You've done great. Now you're getting nervous. What do you do?
I mean, a whole bunch of things are coming to mind. So you can buy puts. You can hedge the whole thing if you know how to do that. We have an options masterclass coming out, so you can do that. You can diversify in other asset classes. You can go into bonds and gold and commodities and real estate and stuff like that. So you can diversify across asset classes. You could sell everything and go to cash and just take the tax hit. You could do some rotation into different sectors. You could, you can be overweight in staples, which for the last year have been getting killed relative to the S&P 500. So Walmart and Procter and Gamble and things like that, and McDonald's and whatever. So or you can do a combination of those things. There's a lot of things you can do to protect yourself. I think I got to put in a plug for the Awesome portfolio. Like, the beauty of the Awesome portfolio is you don't have to think about selling stuff, liquidating stuff, taking a tax hit, being out of the market. You're always in the market. You're always fully invested, right? And the only tax consequences are when you rebalance at the end of the year, right? So, it just goes back to my overall philosophy that you just have to be diversified across asset classes. There is a good chance that we'll have a 20% correction, which will last a year, kind of like 2022. Like 2022 is a great example, right? Like the market was down 20%, like 18%. And at the time it felt like the end of the world, right? And at the end of 2022, the market bottomed and then it went up like another 50%, right? So if you sold everything and headed for the hills, then you missed out on those gains, right? So that's very hard to do. We could take a 20% drawdown, we could take a 30% drawdown, and 2 years from now, we could have another bull market, which you would miss, right? Like, this is why I don't like being long just the index, because you are faced with these decisions every couple of years, right? Like, what do I do? If you're diversified, you don't have to make these decisions. You know what I mean?
That's a great point. I mean, as a Gen Xer who had a front row seat to the great financial crisis, right? Like, I was scarred, and most of my friends were scarred for years after that. The market got so crushed, and it took so long to bounce back. And a lot of us of my age group, my peer group, missed out on a huge, some of them missed the entire next 10-year bull run because they were just scarred.
And I forgot to mention one thing. You always have to have some cash. You always have to have some cash, which in the Awesome portfolio you do. You have 20% cash. but you have cash to take advantage of opportunities. So even if you have 80% stocks and 20% cash, like if the market goes down 20%, you can deploy the cash, right? And buy stuff cheaper, right? Cash is an option to buy something cheaper in the future, right? And so many people are just loaded up to the gills with stocks. They're fully invested, and then the market crashes, and they're stuck. They just can't take advantage of it. Buffett, by the way, has 350 billion in cash, right? Like, and everybody has been like, "Aha, Buffett, what an idiot!" And this happens like in every single cycle. He loads up on cash, and then he starts buying distressed companies, getting preferred stock with all this stuff. Like, it's going to happen again.
The ultimate joke's on you.
Yep.
You write about all this kind of stuff at your website, Jared Dillian Money. I would encourage people to go sign up for you have a free weekly letter, the Jared Dillian letter, creatively named.
The eponymously named.
Yes.
I have fun writing the Jared Dillian letter. What's funny is I kind of forget how that letter reaches and touches people. Like, I'll publish, it gets published on Thursdays. So the Jared Dillian letter comes out, and then people start posting screenshots of it on Twitter, right? Like, look what Jared Dillian said. I'm like, hey, that's pretty cool. So it's a big influential letter, and you should sign up. It's free. Doesn't cost anything.
Can't get cheaper though, even if there's inflation.
We're not paying you to read
it. Yeah, we draw the line there. Jared, always a pleasure talking to you. Thanks for showing up, my friend.
Yeah, of course.